I only listen to Ben Shapiro podcasts. Yeah, but that's right. I got street cred already. So David Eyzenberg, I do a couple of things. At Eyzenberg Company, we're a commercial real estate focused investment bank. We are capital stack, geographically and asset class agnostic, and then we have proprietary private equity vehicles that create them by ground leases as well. And then, part-time to make a real living, I teach. I teach at NYU in the master's program and at the MBA program also. So I have a semester's worth of information here that I got to get out in about an hour. So you have to, I'm going to have to cut some corners. And ironically, this morning, I ran a roundtable for iGlobal talking about equity, just that. So and I'm going to sort of bifurcate the conversation. When I talk about equity, generally, I only raise institutional money. I don't do high net worth. I don't go to the country club with a shul and pass the hat around. It's not what I do. I go to the wrong shul for that. For us, it's always one group, one check. So I will talk about different equity structures from institutions. I will compare and contrast the structures between institutional JV equity and private equity also, meaning from individuals. In fact, many of the conversations that I have when we meet a new client, they tell me, listen, we've raised friends and family, we've sort of ran out of friends and family, and we're ready to scale up and go to the next step, and generally, can you help us? And my first response to them is, you're already spoiled. Because I absolutely know the difference between the different structures they can get away with, we'll call it that. It's not going to get recorded, right? I just want to be careful what I say. So look, there's quite a bit of difference, and I'll talk through the fees you can get from institutional groups, the fees you can get from high net worth groups, and the different promotes, waterfalls, and other good stuff. And then if the boss over there gives me a few minutes also, I'll show you how the actual math works a little bit before he walks you through a model. But I want to give you a general...
You're going to have time for me to walk through. Take as much time as you need.
Okay. Wonderful. I get paid by the hour, right? Okay. Okay, fair enough. So let me give you some broad concepts. We get paid to raise promotable passive capital. Okay, and you're going to hear me use the word promote a lot, and you hear this sort of concept in joint venture equity. And so I'm going to go through a couple of different definitions. Thank God the lawyer's gone. I'm less lengthy in my definitions of these things. The way that I always explain promote is it's bonus, and it's bonus for doing something, right? So it's like I tell my employees, I don't pay you to be a okay analyst, I pay you to be a fantastic analyst. So that's not worthy of bonus. You have to do something special and extra to get that bonus. So same concept, promote. So what does that mean? If I'm buying a core asset, and there's 4 types of investment strategies, core, core plus, value add, and opportunistic. And it's sort of, if I think about the risk-reward spectrum, right? If this is risk, by the way, as I write up here, understand that English is my second language. That means I can't spell. So you're not allowed to make fun of me. So it goes core, core plus, value add, and opportunistic. And most investments, whether it's geographic, asset type, or strategy, will fit into one of these. Depending on which of these you're doing, will dictate who you should go get your money from and how it's going to look. The nature of the money is going to dictate the structure that it's going to give to you. So understand these investments. Core is just buying something like a coupon clipper and doing nothing with it. A Walgreens, not necessarily core because it's a small stabilized asset, but I don't know, that building over there, the big one. That's a core investment, okay? Core plus means it's a core asset with a little bit of vacancy, meaning there's no repositioning required, there's no re-tenanting required. It takes a little bit of attention, generally on the leasing side, to get you to a core asset. Value add is sort of that magical part of the real estate market which requires a human skill set to do something or accomplish something, or money. So a heavy repositioning, a mismanaged situation, you are actively doing something to create value. That is where a lot of the money today is actually focused on. And then you have opportunistic. I always throw in development in that bucket, or land, or Nebraska in general. So anything that goes on that spectrum. And let's think about promote, right? So you're out there raising money. You don't have enough money, you want to go buy something. Why should somebody pay you promote? You're going to do something. We get clients, or prospects. They never become clients for that. We get prospects that come to us and say, well, I want to go buy that building for 4 cap. I'll sell it for 4.5 cap maybe, or 3.5 cap in their model. Can you get us LP equity? And my answer is always no, I cannot. Why? for a core deal, especially in the institutional universe, if somebody wants a large asset where there's no necessary requirement for intellectual capital, where I can hire a CB or Cushman to manage it for me, I don't need the local operator. There's nothing that you can do to create value. People pay you promote because you're going to add value in some way, shape, or form outside of just finding a deal. The deal you can always get a fee for. But to actually do something in operations, that is what you're going to own promote for. So from our side, it is practically impossible from the institutional universe to raise promotable capital for core. There's senior subordinate debt, senior subordinate equity, which is sequential, that I'll talk about later. There's preferred equity, which is possible, but not your traditional pari passu. And I'm going to throw terms. I will eventually define all the terms, I promise you. Core Plus gets a little bit easier, but still hard, generally for the large institutional deals. And my definition of institutional deal is 30 to 40 million or more of total size. So that means a 10 to 15 million dollar check of equity. And then for value add and opportunistic, this is really the best place in my mind to go to the market to get institutional equity. Now, can you raise individual money for this? Absolutely. Individuals, you know, my grandma can't go buy the building, even if she had the money. She just doesn't have that, you know. If she had the money, doesn't have the capabilities to do that, doesn't know how to hire an asset manager. So there are situations where, you know, people will do pooled vehicles like private REITs and such, where you can get some private money to go and do core assets. But for the most part, that's not sort of where we play. Also, we think about size. So I break up the equity universe into three portions: sub 10, more than 50, and then everything in between. And again, putting on my institutional hat, it is easiest to raise $50 million or more, ironically. Why? Because the groups that have that sort of money to deploy, they're in the asset allocation business. I go to Heitman, I go to Blackstone, I go to AIG, whatever it is. They have specific boxes that need to get fit. They have specific allocation. If you bring them a deal that fits, there's a high probability that it's going to get done. Sub $10 million is sort of, you know, the high net worth world, right? And for anybody that's ever raised or tried to raise, by the way, I've done that. I've tried to raise high net worth money, and, you know, that's when I had hair. And it is usually a function of happenstance or relationship. People will give you money because they love you and know you or trust you, or you got lucky. It is very rare that you have, you know, the doctor that's sitting there saying, man, I need a 5% allocation to hotels in this market, but only if I have an industrial allocation there also. Just, that's not how they work. So the individual market is a function of happenstance. The large institutional market is a function of portfolio allocation, and then the middle part, which is the most cuspious, meaning there's the most amount of groups out there, is the 10 to 25 million dollar chunk. And there it's interesting because you have tremendous amounts of pools of money that deploy it, but also it's a function of happenstance and allocation. So for example, we had and I'll give you everything with deals. So we had a deal up in Norfolk, Connecticut. I'm sorry, not Norfolk, Norfolk, Virginia. Great deal, institutional quality sponsor. Everything was right, but for where it was. Because nobody was sitting there when they're doing their portfolio catch saying, man, I have to be in Norfolk. Or Norfolk, one of those, with an Nor. I have to be there. We couldn't find somebody that said they wanted to be there. We did finally find a group that said, all right, we love that market, but we already have 2 deals there. We're oversaturated. One group said, well, we're exiting, so when we sell it, come back to us. We said, well, we should be halfway built by then, so we can't do it. So even when you found the groups that liked the specific product, that liked the specific structural location, if they were already over-allocated or busy somewhere else, you couldn't get the money. So you're going to find that it's actually challenging to find and raise money depending on those pools. So where are the different types of pools? Yeah.
Can I just ask a question?
Yes, and by all means ask questions as we go.
So these large institutional funds are looking at more on a macro level. They're putting more emphasis on the geographic location as opposed to the individual asset?
Yes and yes. So here's the answer, okay? Institutions are very much like lemmings. And they like to go where there's liquidity. And you hear a lot of institutional groups talk about liquidity. So for example, I have friends that love Memphis. And we finance stuff in Memphis, right? I don't know if I'd go there to these markets, personally. But you know, you're buying something at a $5,000 a door, spend another $4,000, all of a sudden you got a 30% return. You can't do that in New York. You could not find an institution to go into those deals. Why? Because there's no one for them to sell to in those markets outside of other private markets. So the large institutional investors, they look at the big 6 or 7 markets, you know, Boston, Washington, maybe Miami, not really. You know, Houston, Dallas corridor has sort of evolved, Chicago, and then LA, San Francisco. Once you get outside of those core international markets, then you're into what we call the secondary markets, where I actually believe the greatest growth is. So those are 24-hour markets. I'm a fan of the 18-hour markets. Nashville, Fort Lauderdale, Tampa, Charlotte, Raleigh, Denver. In fact, when we buy our ground leases, last year we bought about $120 million. I bought in Nashville, I bought in Orlando, I'm buying in Chapel Hill. I don't want to buy at 3 caps in New York. I'm happy to buy at 4 caps in those markets. And there's some institutional presence. Now, those are called 18-hour cities versus 24-hour cities, because the clubs close at 2. So,
what type of property? Office?
I'm agnostic. It doesn't matter to me. Yeah, yeah. Anything that is a non-commodity, like single-family housing, right? So, yes, from a appetite, if you want to talk about appetite, right? Historically, it was always multifamily because the demographic trend is always for multifamily. Today, it happens to be industrial. I worry about industrial, but you know, if I was to go in order for what does the equity want today, it's multi, it's industrial, and then everything, pretty much everything else lumped at the bottom, right? Nobody wants retail because retail is oversold. Nobody wants condos because God forbid you build condos. Student housing is fantastic. We closed a big one in Chapel Hill several months ago. Feeding frenzy. The esoterics, you know, the self-storage, the...
Offices are slowing?
So it depends, right? There was this great creative office concept, which was great. Suburban office has sort of... Office is very cyclical from both... there are 2 types of cycles, right? There is a secular and cyclical, right? So in a secular shift, things always change, right? Period, the end. Office tends to go cyclical, so when you get into the end of the cycle, office leases are how long generally? 3 to 5, 5 to 10, depending on where you are, right? At this point of the cycle, all that stuff has turned for the most part. So the value add stuff in most office buildings, unless you had a really long lease, like it's run its course, you're done, right? So it's actually very hard. We did a lot of office deals 4 or 5 years ago, where you had real heavy, you know, heavy value add lift properties, where, you know, half your tenant base is going to roll below market. I'm going to feed the property because the prior guy didn't invest into TIs and LCs. We got lift. Today, those deals are very hard to find. So office is just not that sought after in the suburban markets, in the urban markets like New York. Yes, why? Because it's like a piggy bank until UBS leaves, and then you're not in piggy bank anymore. But again, the darlings of the market for equity are multifamily and industrial, and then everything else is a distant 3rd, 4th, 5th, and 6th. So then, where does the money come from? So I segregate the capital markets, I'm sorry it's going to get covered, but you'll see it on the other sides, between direct balance sheet providers and capital aggregators / allocators. Who you get your money from will definitely differ based on the type of deal, the size of the deal, what you want to do and accomplish. In no particular order, on the direct balance sheet provider side, insurance companies, pensions, endowments, and sovereigns. So those are like the massive guys, right? Sovereigns, you know, maybe we all do deals with them one day, right? Generally $50 to $100 million minimum per check size just for the equity. So you're talking $200, $300, $400 million deals, plus a chain. Insurance companies, there are still a few, AIG being one of them, I don't know, W.R. Berkley, Northwestern Mutual, that have balance sheet allocations to do. They generally do not, it's interesting, if it's for balance sheet, they will do core, and they will also do opportunistic, meaning development. So they do what is called build to core. So years ago, I did a deal in Jersey when I was at Ramius many, many years ago with Northwestern Mutual. They put up 50% of the equity and the senior loan. We built. And you're thinking, well, why would an insurance company do that deal? Well, because if they were going to go into the market and buy a multifamily at a 5 cap, but the yield on cost, meaning the stabilized NOI divided by the cost to build, is a 7, and they hold it into perpetuity, what do? They just made an extra 200 basis points arbitrage. That's fantastic. So you actually have institutional investors that'll do development with a hold concept, and that is called a build to core. And so instead of buying at really low cap rates, I'm going to build and hold on to it into perpetuity. That is one way to get into an institutional deal with an insurance company. Most pension funds and I'm saying most pension funds do not do direct real estate investing. They generally are going into funds. Some of the really large ones, like a CalPERS, a CalSTRS, will do, like with like a Larry Silverstein sort of deal, but not at the small local level. Endowments, I can only name 2 that do direct deals. The majority of the others, meaning the school endowments for the most part, or hospital endowments, they're all going into funds. REITs aren't really doing as much as they used to in JV. There used to be opportunities to do that. Where their REITs are active, or some of them, like Essex, for example, is they're doing preferred equity off their balance sheet. I'll talk about preferred equity, which to me is synonymous with mezzanine, just a different legal structure. And then you got the family office and the high net worth syndications. And this one is the most interesting to always talk about, because when I get a call from someone and they say, can you raise me private money? Right? I sometimes will substitute that with, can you raise me Chinese money? And then I will substitute that with, can you raise me dumb money? So the high net worth market is the broadest of markets. And it is the most varied. There are no rules. There are no specific laws outside of the legal stuff. But we're talking from an economic effect. I've seen people raise money where they have no co-invest, no preferred return, and 50-50. God bless you. I want to be in that business. And then I've seen it all the way to the other side. But what I want to differentiate is sort of there are family offices that are institutionalized, meaning they are in the business of deploying money. They hire private equity guys that wear suits and ties, and they are running it as if it was a Blackstone. And they're deploying money for the family and putting it out there. It's not like the patriarch waking up in the morning saying, man, forget about that Caribbean trip, I'm going to give you money for this hotel deal. That's a different sort of execution. That's like the luck and happenstance one. So you have a interesting number of family offices. And then you have the high net worth syndication. Who here has raised money from just people in the neighborhood? Yeah. Friends, he's a nice boy, give him a chance sort of thing, right? For the most part. A lot of chicken dinners. Have you ever done crowdfunding? Anybody? You know what crowdfunding is, right?
Share estates. What is it?
Yeah, whatever it is, yeah. That crowdfunding, think of it as online syndication. It's just a technology, right? So crowdfunding is sort of like versus you doing it. You give it to them, they put it on a platform, and then they distribute it to the high net worth syndication market. A big one just recently closed down was Realty Shares, which we were actually on with a deal when they luckily sent back our deposit for something, so it was good. I actually think that, and I'll give you an interesting statistic, right? Because at a lot of conferences I get asked 2 silly questions. What inning are we in? Whatever. I think about quarters or rounds, right? So I have no idea what inning we're in. I know we're closer to the beginning, to the end of the beginning. And then they talk about, well, what do you think happens with cap rates, right? Because that dictates how you raise money. And I go, I actually think that there's room for cap rates to compress. And people are like, what are you talking about? Everything's so expensive already. 3%, 4 caps. How can that be possible, right? So a cap rate is a function of 2 things. A risk-free rate of return, which is the Treasury, which, by the way, is still going. And the magic thing is the risk premium. And the thing that most people don't understand about a risk premium is risk premium actually expands and contracts to meet demand. The more demand there is for something, the lower return people are willing to get, right? So, the Chinese really wanted New York real estate. They overpaid the hell out of it. And then what happens to cap rates for the core stuff? They contract it. As soon as they pull out, they maybe widen out. I'm going to give you an interesting statistic for those of you that raise high net worth money, and especially the crowdfunding concept. Okay? There are $24 trillion in retirement assets in the U.S., just in the U.S. alone. Split 50-50, defined benefit and defined contribution. Defined benefit is simple. That's the AT&T pension fund, right? Because it's, I've never had a defined benefit. I'm too young for that, right? But for the older people, right, or for the teachers and CalPERS, they have defined benefit plans. So they're already in the market. They're all invested into funds. What is not in the market are the defined contribution plans. Who has a 401k? Come on. Everyone should have a 401k at least. Or IRA, whatever it is, self-directed, right? So you have something. Okay. $12 trillion in the market. Okay? If I put a 5% allocation, which is what the institutional universe puts for real estate, forget about more, just 5%. 5% of, I'm not offended, 5% of $12 trillion is how much?
600 billion.
Thank you. $600 billion of money that has not yet entered the market. It will, right? My 401k, I'm still, again, I'm not at that age where it has to, but it will come out, and that's only at 5%. In parts of Europe, it could be up as much as 10%. $600 billion is more than the sum of all of the other, outside of the big three, fund managers of capital that is in the market. So $600 billion is a lot of money. A lot of money. That has not yet entered the market. When that market, first when that money trickles in, what happens to risk premium? It has to compress, because it's just more money chasing the same amount of deals. The deals don't get more, it's just, there's less of them, in fact. And more so, how do you capture that money? How do you capture that old lady in Ohio? There's only one technology that actually exists to capture it. Guess what it is? Crowdfunding. That's it. That is the only technology that exists to capture that. So I actually think that right now you went through a dip because you sort of saturated or matured from the people that you can actually raise money from on the crowdfunding vehicles. And generally they tend to be small. I think the most is like 1, 2, 3 million. The largest that was raised was I think $7 million. And like we put one up for a client. So we did a 90-10 deal, and then we took his 10% co-invest, which was like $1 million, and he's like everybody else, I had too much money for me in a deal. So we said, we'll recap out half of it through a crowdfund. And we were sitting there watching, like, 10,000, 5,000. Eventually, they syndicated out like 750 or something. So right now, it's still tight, and to some extent, you've sort of matured in the marketplace, because you can only go after, and this is, I'm not an expert in this, you can go generally go after the accredited investors only, which is less than 5% of all investors. So add the other 95% as the laws change, and then add the $600 billion that hasn't come in into real estate. That is massive, massive. So I think this is where, you can't see me point, but that's still where a lot of the heft is going to go and will help drive a lot of the equity. So then on the institutional side of the capital aggregators and allocators, this is generally where we spend a lot of our time on, and that is the private equity fund, the real estate fund, the hedge fund. Anybody know the difference between the three? Yeah, neither do I sometimes. So I'm a big believer in proper terminology, right? So when I hear private equity fund buying real estate, I'm like, that's not a private equity, that's a real estate fund. Private equity is companies, right? Hedge fund, I'm like, well, are you actually trading or hedging? No. There are structural issues, but for the most part, the true hedge funds are actually doing very short equity bursts. Most of the aggregated capital, actually for a lot of this stuff, is in the real estate funds, which are set up as private equity funds, meaning commingled, closed-end vehicles. Commingled means there's more than one investor in there. Closed-end means that it has a finite life. 10 years and everybody gets out versus open-ended funds. Crowdfunding I talked about, and then EB5, done, right? I pick on China a lot today, but no China, no EB5, we're done. They're not enough Russians with money anymore to do that. So what does all this mean? There's a lot of places to get money, right? I don't need to talk about governance issues. You're all very honest-looking people. So here's now the other topics. And this now goes to structure. I'm going to make this a little bit bigger so you can see. So when we raise capital, right, we think about what is a doable deal versus a non-doable deal, right? And there is the marketability of the business strategy, and then there's also the marketability of the client. I forgot, what was the attorney's name? Andre. So actually, Andre actually touched on it a little bit, right? So for example, I love these conversations. I owned a ton of multifamily, but I'm going to go build a hotel. Okay, right? Or I own a lot of multifamily I'll give you a perfect example, a lot of multifamily in Denver, but I want to buy a multifamily building in Tampa. And those are actually really hard to raise money for a couple of reasons. When people give you equity, and it is more so because you're at the most top part of the capital stack, they are really depending on one thing, that you actually have an expertise in doing what you say you do. And the only way that you can prove that is with track record. It's not by saying I'm really smart. It's not by saying I can do it. It's actually by demonstrated track record. And so I find it absolutely amazing. The deal that I discussed, we had a client that had 3,000 plus apartments in Denver, went to go after a deal in Tampa. We found one group that would give him equity, and that was only because they already had a pre-existing relationship with them on a Denver deal. We could not get anybody to give him money. Why? I have to believe the humans in Denver, regardless of pot, are no different than the people in Tampa, right? But because it is a different market, because it is a different lease-up strategy, because it is, if you're doing a heavy lift and you don't have all the right crews there, they felt you could not execute. So geographic concentration really matters. And so what we've seen, for example, if you're looking to get into another market, is you partner with another local operator, at least as window dressing, right? But we won't tell. Get a deal done, get presence, and then use that as a launch pad. So it is very challenging actually to get institutional JV equity for a new geographic focus and also for an asset class. I assure you, now again, I've only run multifamily in my life and ground leases, and that does not take a lot of skills. But I've financed billions of dollars, and I've seen the stuff. It is very different running a hotel than a multifamily asset versus an industrial deal versus a retail deal. Very different. And if you don't have the core competencies and skill set in one of those, it is very challenging, again, to get it from the institution universe. Not from the private universe, because they'll give money to anybody that they like. From the institution universe, it's a little bit of a different vet. So there are a couple of concepts that we think about when we do equity, right? And what's the first question everybody asks? What's it going to cost me, right? Promotes, hurdles, all the good stuff. I said, don't worry about that yet for a second. Let's get to the structure first, right? So there are actually 3 ways that equity can get done as a structure, and I will tell you a trend that we have seen. There is the preferred equity, the pari passu equity, and the senior subordinate equity. And we are doing a lot of actually senior subordinate equity. So what does that mean? When you think about the typical cap stack, and I mentioned I can't draw or spell. Okay. So, you know, I'll do a cap stack for you, and I'll use some terminology. I'm sorry if you can't see there also. Okay. First mortgage, right? Or senior loan, or senior secured debt. What's the collateral for the senior loan?
Real estate.
Asset?
A mortgage on the asset, right? You give a mortgage to the lender. You don't get a mortgage from the lender, right? You give a mortgage to the lender. So senior secured by the asset, right? And then you have what I call the structured product bucket. If I actually have both, as far as seniority goes, you have mezz and you have pref. And if you notice, the attachment point is the same. Attachment point is jargon for where do you attach on this scale. So if the senior loan is 65% LTV, the attachment point is 65%, meaning the mezz starts after the 65%. So when your attachment point, that's what it means. Mezz, right, I don't buy this as David Eyzenberg. I form DE LLC. Mezz is secured by the partnership interest of the borrowing entity, right? It's a corporate loan. Preferred equity is actually invested into the equity as senior. From an economic standpoint, for the most part, I view preferred equity as the same bucket as mezz. The only difference is the legality of it. Why? Same attachment point, same last dollar exposure, and generally speaking, same pricing. There are reasons why you may choose one over the other. For example, if you're doing a Freddie Mac deal, what do you need to do? Mezz or pref? Freddie allows only what behind them?
Pref. They don't let any subordinate debt, right?
Good, pref, right? Fannie only allows mezz.
Mezz?
Good. There you go. That's one or the other, right? So legal structure. That's it. I mean, that's another semester's worth of conversation. If you're doing a CMBS deal, right, and you have a prohibition on transferring more than 42%, can't get a second mortgage because nobody allows second mortgages, right? Unless you've pre-negotiated the right to put in mezz later within the creditor in place, you have to do preferred equity. You have no option for it. So there are times when you have no option. There are investors, for example. If I'm a tax-exempt institution, I don't want to do preferred equity because now I'm a dealer, I have ordinary income, and I get hit. Whereas if I do mezz, so there are tax reasons under FERPTA to do it. There are tax reasons, there are legal reasons for the senior, but for the most part, mezz and pref. And the pref is simply above the senior and up to a certain level. What is that level? My rule of thumb is about 85%. And it almost doesn't matter. And by the way, there are always outliers. I get it. And if it goes up higher in the stack, then you get into the kicker world, meaning you get a piece of the common equity also. It is generally in here, right? For core assets where you can't get 65% because the cap rate's so low, maybe this drops to 55, so the attachment point is 55 to 70 or something like that. But for the most part, I've rarely seen it go above 85 because also you have holdbacks and some other structures. So what happens above 85? This is the equity. So when people talk about preferred equity, it's not really common equity. It doesn't go high enough. It doesn't replace you. What it does is it creates a little bit of leverage for you and takes you into the structured product bucket. So pref equity to me, structured product. The common equity, which is when you go raise equity, that's sort of what you want. By the way, you can always avoid mezz or pref if you don't want the fun fact. Most institutional investors do not want mezz or pref in their deals. Why? Because the current coupon, if I have to pay the pref at 12 and the preferred return to the investor is 12, they're going to say, well, why the hell would I ever pay anybody else the 12? I'll pay it to myself. I'll give you more money. So when you deal with the larger deals with institutional investors, you generally will not have mezzanine and pref. You will have a JV equity partner and debt, period, the end. The common equity can get structured in two ways. Pari passu means equal or some sort of sequence. Here's a picture of equal. Why is it equal? Because when losses start, they hit you proportionate. So if you're 90-10, meaning you put up 10% as a GP and the LP put up 90%, right? I take 10% loss, you take 90% of the loss, right? So we get hit equally based on our proportionate share. The senior subordinate structure, which is what we're seeing a lot more of, and I'll explain why people are doing it, is the GP is sitting behind the LP something, and there's also some variances. It could be return of money, it could be return on and of money. So pretty high levered position. Actually very high levered position because you're sitting behind a lot of money. What's the trade-off? A lot more upside, and I'll talk about how the promotes will differ and fees and such will differ. So in summation, the cap stack, senior loan, mezz pref, same thing. In the common equity, senior subordinate, meaning the GP gets hit first, the LP gets the money first. This is pari passu. The majority of joint venture deals are done like this. More and more, we are pushing for and seeing deals get done like this. Why? So, and this is actually, I spoke about this trend in the morning. Somebody did ask me, unfortunately, that silly question of, where are we in the cycle? I said, probably near the end. How do I know? Because the capital says, I am worried. I want to be defensive. I care about basis. The equity has become very focused on basis. And how do I invest into equity and still protect my basis? Well, this. So you see equity providers that have been historically pari passu, cycle down and stack. Some are just doing preferred equity with kickers. Some are doing the senior subordinate structure. Yeah.
LP is fully protected?
Define fully protected.
I mean, that's what I'm trying to understand. What's that?
It's not a guarantee of anything. All you're doing is, so let's say it's a 90-10 deal.
Right.
If there's a 10% loss, the GP takes that hit. It doesn't touch the LP. So the general partner's equity contribution is subordinate to the limited partner's contribution.
After that, it'll fall to the LP.
I'll walk through some of the deals. I'll actually give you real life deals and hurdles and numbers and everything for both pari passu and some other stuff. And then I'll show you, what time? When people start, no, okay.
I can listen to this for another 10 hours.
I can't talk for another 10 hours. I don't know if I'll go through a model, but I'll actually give you the famous waterfall bucket lecture, so you'll at least understand what it looks like when you talk about pref, all right? So this is how this stuff gets structured, right? And then we talk about co-invest. Who here raises money from private net worth, guys? Okay. Has there ever been a deal where you didn't invest something into the deal, meaning you raised 100%? No.
First question.
Huh?
That's the first question. They
Yeah,
want to see
you put money into it.
Okay.
they want to see
Right, so,
you-
right. So as I walk through this, right, I am very much focused on an alignment of interest. And a lot of times, it's not just the legal aspect, it's the economic aspect. Right? Sometimes deals go sideways, not because the asset is bad or the business strategy is bad, it's because the alignment is just off. My opinion, which is sometimes unpopular, and I can give you the pros and cons of the opinion, I've actually worked on the institutional side early in my career, so I can argue both sides, is nothing creates an alignment of interest except cash. That is my belief. Not land lift, not step up in value, not whatever it is, and I can walk through a lot of that stuff. Cash, period, the end. And I will give you a primary example. So what does that mean? If I need $10 million of equity for a deal, and I go to institutional investors, they're going to say, hey, what is your, and I hate the phrase skin in the game, they're going to ask, I need for you to have skin in the game, meaning your co-invest to create the alignment of interest. And you're actually going to have some variances in this also. So, oh, I bought the land for $5 million, it's now worth $20 million, I'm going to contribute it. Here you go, that's my equity. No, right? Or I got that deal off market, I got a really good deal on it, you know, it's an old lady, she knew what she was doing, I bought it cheap, that's my equity contribution. No, that's the answer you're going to get. I understand you might have created value, but that does not create an alignment of interest. The argument that a lot of sponsors have made is, I don't need to put equity in for 2 reasons. Number one, if the deal doesn't do well, I don't make any money, my time is valuable, I'm going to spend time doing all the work, you're not doing anything, you're just an investor. Argument number 2 is, I'm recourse on a debt, whether it's a completion guarantee or bad by carve-outs. Therefore, there's alignment of interest. If things go bad, right, why not? And in fact, you know what I'm going to do? I'm going to play a game with you. Is that okay? Because you're all going to get tired soon anyway. Where's your stuff here? That looks all very complicated. Are you going to do this really?
No, this is...
Oof. Okay. All right. I'm going to make believe this is an actual deal. Okay? Yeah. You guys good for a game?
Yeah.
Okay. Well, it's like role play. Role play. And we're only going to focus on, here, I'll move this also. I'm going to give you some information. By the way, you can do this, whatever I'm going to teach you, you can actually take and use when you do your deals. I promise you. I'm an experienced operator. The deal doesn't matter where it is or what it is. This is the actual answer. I did my analysis. I buy the deal for $15.2. I get some debt on it. I need $1.52 million. Here's the after-debt cash flow. And the IRR on the deal is 20.4%. For now, just believe me. Don't argue with me about how do I know you underwrote well or whatever. Just make believe right now that I did, right? So I'm going to go, and you're my investment pool. Okay? I need $1.52 million. Okay? I'm going to give you an offer. You ready? I'm going to do all the work. I'm going to put up all the guarantees. I'm already skipping ahead to normally what I do. I'm going to put up all the guarantees on the debt, right? I'm going to do all the work. I'm going to pass the hat around, right, to all my good friends. I'm a good guy. Everybody knows me. And you're all going to kick in $1.52 million too. So you're going to put up 100% of the equity, but I'm going to do 100% of the work. You're going to get your money back first, and then we'll split the profits 50-50. And for now, just believe me that that is correct underwriting. Who's with me? By the way, when we played this game, there's one thing you cannot do. There's one argument you can't make. You can't make an argument of greed, meaning you can't say too much or that's too much for you. I hate those arguments.
What's the return?
There, that's the return. Don't worry about it for now.
Oh, the IRR.
Yeah. That's the deal level IRR. Okay? So again, I'll say it again. You give me money, you go on vacation, you go about your jobs. You're an accountant, you go do your stuff, you go to the beach, whatever it is. I have to live with this deal for the next 5 years. Doing everything. I'm recourse on a debt, by the way, also. You get your money back first. I don't see a penny. And then we do 50-50. Who's made that pitch, by the way?
If you're not key principal.
Huh?
General, how do you become recourse if you're not key principal? Don't you have to have enough money to qualify as key principal?
No. So in CMBS, you need a nexus. So yes, I put in $1 of the co-GP money. Yeah. The answer is you can be.
Freddie and Fannie?
Fannie and Freddie are different.
Okay.
Yes.
So the IRR is really half that, 14.2.
It's not exact.
half
It's
it.
not exact, but yeah.
I'm saying if you want to split
Yeah,
that,
sure.
50%.
Yeah.
So if a guy's happy making 14%.
Yeah, that's why I'm not talking. You can't make an argument if that's too much or not enough. So just think structurally, because I guarantee a lot of people in this room have actually made that pitch, right? Be honest. Come on, somebody has made that pitch to investors.
That much.
Yeah. Okay. So who's going to give me money? And if you're not, give me a why not. I have 5 years of my life in the game. That's worth something. I make actually a nice living. I have to pay attention. Is my time not skin? I'm recourse. Who's with me? Who's going to give me money? No? Still no?
Friends.
Huh?
Family.
You're my family and friends. We're all friends now. Come on. No? Why not? If you shake your hand no, you got to give me a reason.
I also said the game.
Huh?
In the same game, I'm trying to save for when.
All right. I know. I'm sure somebody has this conversation. I want to know. If the answer is no, I want to know why.
If a guy's not putting money into a deal, I wouldn't want to invest with him.
Okay.
He doesn't.
Why?
Doesn't believe in it.
Because
I want my cash back first before.
No problem. Your cash back comes back first. I said that.
people are usually optimistic. People are usually optimistic when it comes to an investment, from the developer and the investor perspective.
Okay.
So he's thinking in his head, he's going to be successful and he's going to make everything work out. He's not
Okay.
thinking about the losses that may potentially happen, and he's not.
Okay.
You're not just running one deal.
Okay.
You have-
You're arguing from an emotional standpoint. I just want you to think. Remember, I'm here not to talk emotion, right? I'm actually here to teach you math and stuff, but there needs to be a reason for the structure, right? So,
I think if you only take 10, 20, most people would go in with you.
okay.
It's not competitive with what's in the marketplace.
Okay, I could take that argument. I could take that argument. But what if that return is competitive in the market?
Well, the return, but the structure, the arrangement.
I understand, but you have to give me a reason why. I keep hearing, yes, I get it. Why?
70% IRR.
Well, I mean,
I can
guess
up the
only
IRR if you
reason why
want.
would be if you had something else to put up against it that you thought was a better
I
investment.
know. Why do you think I need skin in the game? Well, I just told you my time is there, and I'm recourse on the debt.
Well, you
Am
said
I?
before alignment of interest.
Okay. Alignment of interest. Well, I gave you sort of the answer, right? Alignment of interest. Okay. So in other words, if things go bad, I'm not incentivized to do anything. And in theory, my time is my time, right?
You probably have other investments, so if this one goes sour and you have other investments you do have
Wait,
to do the game, this is
but my time is valuable. Yes? Everybody's right. Okay. I'm recourse on a debt. Let's make believe I actually put recourse on the debt.
So hand the keys back to the bank if it starts becoming an issue, and that's it.
Yeah, but it's because you can't calculate the return on the general.
Okay, I'll give you an answer because time, right? So all of you are making right arguments, but I want you to understand why, right? Alignment of interest is key. Period. The end. I have had sponsors get away with the argument of recourse debt, and you said I just hand back the keys. The answer is actually that's one of the main answers. There's a client that I had based out of a city that raised over $1 billion of cash from high net worth individuals from overseas, and they put zero into every single deal. Zero. In fact, they took cash out with fees, which I haven't even gotten to yet. Their entire argument was time, investment, right? Time. If you get your money back first, so obviously we need to pay attention, and the recourse. And in 2008, things were not so good for those of us that remember. Not so good. So they spent a year crisscrossing the country, doing what? Not protecting the equity. What were they doing? Handing back the keys to get off the guarantees. I have seen this consistently over and over again. Unless you have, there's the rule of 1 for 10. You feel your losses 10 times as much as you feel your gains, right? Unless you have cash that you feel, and this is now a psychological thing, it is very different than getting land lift. It is very different than getting an embedded value or the upside of the promote. People feel cash. It is a psychological thing. On every single deal that I've ever seen go sideways, for the most part, it is generally a lack of alignment, which was from a lack of investment. And putting yourself on the debt is absolutely, it's a perverse counter reason because you're worried about your balance sheet and you have nothing to protect. You don't care about your equity. You will bury the deal. Bury the deal. People will make the argument, though, oh, but I got my reputation. Huh? Reputation, I would never do that. Well, they did it. Guess what they're doing now? They raised another $1 billion. It didn't matter. Memories are short. I don't know. Didn't matter. So there was no alignment of interest, all right?
Can't the lender come after the sponsor because it's recourse? In other words,
Here are the keys. Deed in lieu. Done.
Let's say it doesn't cover it.
I either do that or I file for bankruptcy. What do you want? Here are the keys.
Even if
A lender can do anything. I get it. But most lenders, I'm not talking about the debt funds that'll take your underwear from you. I'm talking about like a bank, an insurance company, or CMS. They are happy to do deed in lieu.
If the building's worth less the value, they can
It
come
doesn't
after
matter.
you.
It takes two.
But guys, believe me, if I fight you, right? I have a guy in my office, Robert Eyzenberg, that ran large loan workouts for Torchlight. He worked out like $5 billion. And I heard him tell me phenomenal stories where the guy would fight it out, would fight having a servicer put in, and the property will go like this, I promise you. Degradation of the NOI and the asset value is like this, like a steep cliff. It is
For the time.
always better. Take the keys,
The
always
IRR
better.
is going to be lower. I've been through the
Yeah,
process.
always take the
Yeah.
keys, period, the end. I was the one, I was a Ramius. When we went, take the keys, period, the end. No argument. So, all right, I'm going to put some money in because everybody wants money, all right? I'm going to put in 10% market, 90-10 deal. All right, so I'm going to co-invest 10%. Here's our deal. I'm going to put up 10% of the money. You're going to give me 90%. All the money comes back out, and then we split 50-50. Who's with me? So there we go. I'm going to actually do it. There you go. Yeah, man.
So investors might say the market is like 70-30 or...
Yeah, okay. But this deal is not. If you want in, it's 90-10. 90-10 is market for institutional group. I've done that. Well, I don't want to get ahead of my deal.
Come on, the profits.
Okay, maybe. But this deal is. Remember, you can't argue with I want more.
What?
It's not an argument.
You're refinancing? What's
No, just a sale. Sale. Yeah.
Okay.
Okay.
You're just returning the equity and then splitting all the profit.
Yeah. Yeah. Like a hedge fund. Who's with me? And if you're not, you got to give me a reason why.
Well, maybe I would ask some questions like, are you getting any other fees? Like,
I haven't gotten to the fees yet. But I promise you there will be all market and nothing that no one here has asked
so
for.
there will be fees in addition to the 50-50.
Yeah. Yeah. If I'm going to do work on a deal, yeah. If I'm going to outsource the property management, I'm not taking a fee for
Your
that.
acquisition fee of 1% is going to be your equity. It's going to be.
I haven't even asked for 1%, so let's hold off.
If it meets my IRR,
If it meets your IRR, you don't see why not. All right, man. Me and you're going to be friends. Okay. Who's with that really smart gentleman in the corner? What's your name?
Jason.
Who's with Jason? He's smart. Anybody? No. All right. I'm going to. Yeah? No?
Asymmetrical.
What do you mean?
It's a 50-50 split, and then 90-10.
You got your money back first before I see profit.
So I'm getting back first.
It's 90-10. I'm not supporting. My money is as green as yours. Right? So I'm co-invested. Right? So, any problems? Again, I'm going to speed this up. There are a couple of problems. Number one is the test of meaningfulness. What if I'm worth $50 million? Is $150,000 meaningful for me? Well, actually, knowing me, yes, it would be. But maybe not. Maybe that is an insignificant number for me. Maybe I'm a teacher, and that number is like my annual income, or 2 years of income, or 4 after taxes, right? Right? I'm gonna, I'll get divorced if I lose that money, right? So there needs to be a test of meaningfulness. I have done deals which are 99-1, where the sponsor only had to put in 1%, but that 1% was a meaningful investment for them. I've done deals where it was 30-70, and the 30% it didn't matter, but that was the norm, or 90-10 or 80-20. Generally, we do 90-10 deals. Generally, right? Let's make believe this is meaningful for me. The one thing that I always talk about, right, is how much of the money did I put in? 10%. How much profit am I asking for? More or less than 10%? Forget about math right now. More. I'm asking for more than 10%. Therefore, what am I getting? A bonus, right? Promote equals bonus. Okay. What did I do to earn that bonus?
5 years of work.
You return the capital?
Okay, is that me being back to my employees, is that being a good analyst or being a great analyst?
That's doing what's expected.
Yeah. I'm supposed to give you your money back. You're not supposed to lose money in real estate. If all I did was give you your money back, is that really the standard you want to hold me to? Yeah, that's IR bid. If all I did was return you your money and I'm already in bonus season, is that really the standard you want to hold me to? Of course not, except when you give your money to hedge funds you do. Huh?
You're running the whole deal.
Doesn't matter. Think about what I've accomplished.
There needs to be a promote.
There's a baseline requirement for me to get a bonus. I'll turn it back again to my analysts. Luckily, none of them are here, so they get angry when I talk about this, right?
So loss in time value of money.
If all you did was meet a baseline, you do not deserve a bonus. That's it. If all you did was just, it was expected of you, why bonus? If all I did was give you your money back, yay.
What's after the IRR?
No, no.
You gotta return a certain percentage first.
So, what's the answer? I have begun to earn bonus, meaning promote, before I have exceeded a base return. That's why I keep talking about hedge funds. Hedge funds are 2 and 20 immediately. There is no baseline. You know, you're blessed for giving you money, right? In the private equity world, there's always a baseline. What is that baseline? The baseline is a threshold before promote kicks in. That is called the preferred return. Okay? So, bonus should not be paid before a baseline of a return of money. It's a given. Some sort of return. Because guess what? If I go buy treasuries, am I going to get my money back? Plus, what, 4%, whatever they are today? Do I have to give anybody a bonus for doing that? No. I can go buy treasuries, get my money back plus 4%. Thank you. Right? I have to do something better, hopefully, than treasuries here. Make sense? Okay. So before somebody gives me a bonus, I got to have a preferred return. In the private markets, preferred returns are very small. I've seen as little as 4 to 6%. In the institutional market, if I'm doing, let's ignore core plus. If I'm doing value add to opportunistic, the base is generally between 8 and 12%. In other words, the money, and we're going to define if it's senior subordinate or pari passu, has to earn an 8 or 12% return before you start getting promote, which by definition is an outsized portion of the deal, meaning the profits. So if I did 90-10, if I get promote, that means I'm going to wind up capturing more than 10% of the economics, and I'm going to draw it out how that sort of flows through for you. So I'm going to give you money back, don't worry. Now you know, okay? All right. Before I move on to the waterfall, right, I'm going to say, okay, I'm going to do 10% of the co-investment. Before we do the waterfalls, right, before we do the waterfalls, all the money is going to earn a 12% return. Then I want 50-50.
Including yours.
Of course. My money is as green as yours, right? Sometimes. I'll get to the senior subordinate. And let's ignore the 50-50 for a second, but I need to talk about fees. Damn right, right? We have a machine. We have to feed it, okay? Do you know how I got this deal? So there was an old lady, owned it herself, didn't have an outsourced property manager. She would actually walk around, collect her rent. Her husband would mow the lawn, right? Everybody knows these sort of owners. I went to her house for 3 years and ate her horrible oatmeal cookies, and they were horrible, I promise you. It's a true story, by the way, not for me, but one of my friends. And I got to know her. I listened to her stories about a grandkid. Like, let me tell you, I spent a lot of time on this. Finally got on the contract. Okay? I want a 1% acquisition fee. Okay? Did I earn it? I would say that clearly I earned it. Okay. Can I have it at closing?
Yes.
I earned it. Yes. Okay. What's the math? You already told me the math.
It's 150 grand.
1%, a 90-10 deal. Do I have any cash in?
No.
No. Do I have an alignment of interest? Nope. I earned it. And we see this with institutional groups quite often, right? I've earned it, but they really can't pay me.
You could argue it's you earned that money and now you're taking that money and investing into the deal. No different if you earned it on the stock you sold. I mean,
Okay. Did I come out of my savings? Okay. Am I playing with house money or my money?
your money.
No. House money.
You earned it as a broker, so to speak. You put the deal.
When you get
No.
to the settlement statement, when you get to closing, you're net zero.
You're zero. You're zero. You're playing with house money. And I've had, and I actually agree with this argument, even though it was used on me also. I tried to put a deal together a couple of years ago. We actually went on a contract, and we understood we wanted to, and it was sort of that sort of story, right? And we wanted to get a 1% acquisition fee. And I understood the math. I knew they couldn't give it to me. I go, no problem. I'm not going to take it at closing. What am I going to do? I'm going to subordinate and defer till later. but I want capital account treatment for it. And they said no. And that one was like a pain in the ass. I actually didn't agree with them. Their argument was that unless it's cash, it's not worthy of getting account treatment. Institutional capital generally does not give you an account treatment for those acquisition fees, even if you defer them. So let's ignore that. So, meaning that I'm going to come up with $150,000 at closing here, and because I'm not going to take $150,000 at closing, I've actually invested 20%. They said no. You're going to get 10% of the deal because you put up 10% of cash, and then as deferred compensation, after we get our money back, usually, you can have that acquisition fee later. So in other words, you still maintain the 10% equity in the deal. Yes, you get your acquisition fee, but only after we get our money back. And it's been done in different ways, right? It can be done as after we get our money back, after we get some of our money back, after we get a multiple on our money. So there's some variation. But the key thing here is you do not want to let the general partner at any point in time fee their way out of their equity position. So the first one is the acquisition fee. I earned it. What if it was a CBRE deal? Let's change it, right? Do I get an acquisition fee?
Yeah.
Yeah, why? Because I paid the most? Right. I overpaid, great. By definition, every person that wins a deal has overpaid. Do I earn an acquisition fee on those?
You never know if it costs money.
Did I earn? No.
Did
I earn? Did I earn it?
You look through 300,000 deals to get there.
By the way, I agree with you, both of you, right? You know, I probably looked at 1,000 deals before I got that one, right? So yes, I have lost time committed. The institutional market will go two ways. They'll go either, you're right, we agree with you, or some of them will say for a marketed deal, 50 bips. They will actually chop it down. In the private market, I've seen 2 to 3 points.
What's personality?
No, it's who you borrow money from. it's who gives you money. And keep in mind, for those of you that borrow money, when you go to the capitalized budget to the lender does not give credit for acquisition fees. No, that's equity profit being taken out of the deal. A lender does not do that. So that comes out of equity. You don't borrow 70% of it. So from an acquisition fee standpoint, from the institutional universe, if it's truly off market, whatever that means, it means just poorly marketed, right? You will get your 1%, unless you're going to fee it out of the deal. If it's on market, 50 bips generally you will be able to get. In the private market, you can get whatever you want. I assume whoever has raised money here knows, right? Yeah, 2 to 3 points sometimes. It boggles my mind sometimes. Okay, so we're good with the acquisition fee. How about a disposition fee? Who gets those? Raise your hand, be honest. Disposition fees?
Was that
disposition? So disposition when you sell.
Oh, you sell.
Yeah, I know you got to put some paperwork together, right? Work with the broker. I get it, you know. I'm being recorded. Come on. No. Disposition fees? Institutional world, 0. Forget it. Okay. Here's an interesting one. How about a guarantee fee for the debt? Who gets those? Anybody? No? Okay, you do?
What if no, but what if if you don't have the balance sheet and you have to bring someone on? Can you incentivize them that way?
Good question. All right. I'll come back to that. Let's just make believe for a second that it's you, as a GP, that is guaranteeing the debt. Yes, no? I have a client that we moved from private to institution because he wanted to scale up. On his private deals, he was getting 75 bips per year for the loan guarantee. Ironically, in a non-recourse loan, so it was just bad by carve-outs. Not stupid. Uneducated investors, or what we call retail investors. No?
That's the whole part of the attraction that you're
I understand. Nah. So here, I'm going to teach you the argument of how to go back and forth, okay? Institutions will say very simply, you're earning promote for doing something. It is part of your job to capitalize the deal. So it is incumbent on you to provide whatever balance sheet requirements are necessary to get the debt. Because if there's no debt, there's no deal. I'm not investing money with you. That is the institutional mindset. Period, the end. Okay? The counter is only, in the institutional world, if the loan is really recourse. Because here's the argument that you make. If you went non-recourse, let's say you go CMBS, right? You know, 220 over. If I go a bank debt and I'm at 150 over, I've created value that accrues to you, and therefore I should be compensated for it with a guarantee fee because it is immediate benefit to you. And you could maybe negotiate with some of the smaller funds. Big funds don't want to hear about it. Only if you are creating tangible value that they can see can you charge a fee for it. From the private guys, you can charge, again, you know, sort of whatever you want, right? Now, what if you on your balance sheet can't do it? There are limited partners institutionally that'll put up the money for you. For example, Carlyle is famous for this, right? They'll put up a completion guarantee for you, but there's a cost to it. What does that cost? They're going to take half your promote, right? There are funds that are docs precluded. There are funds or family offices that could do it for you. If you have to use an outside, so on development deals, for example, we find that our developers are not the biggest, you know, generally our clients are middle market entrepreneurial, so proceeds from pricing, and they're always generally short on cash, like all real estate people. Without cash on balance sheet post-closing, you really can't prop up what we call a completion guarantee. So you have to pay someone to do it. It's either going to be the LP, or if you can find a GC also that wants the business as a GC, they'll put up their balance sheet for a fee for that. But that is a look-through cost. I'm talking about when you yourself could do it. So what's the summary? Acquisition fees, yes, as long as you don't get feed out of the deal. Disposition fees, forget about it. Guarantee fees, good luck making an argument. But at least I gave you what to make an argument for.
Have you seen equity commission fees? So the institution's not
Yes.
paying the whole
So
money. Just
yeah.
half the money, you have to go raise the other half.
Yeah.
You have-
So good questions, and thank you for asking that, because surprisingly, I'm not altruistic. I have 4 kids I got to support, so we actually charge money. So there are different scales of fees, and we actually talked a lot about it. I was surprised in the morning, right? Broker dealers that go out and raise this, you know, can have a load of up to 12%. That's not what we do, right? So for us, it's one group, one check. In the institutional market, for the legitimate groups where there's no retainers, not like fund placement work, right? There, there's usually a retainer. And ours, where it's one group, one check, private market, or institutional private market, there's a fee. If somebody asks you for a retainer, forget about it. And we charge, again, depending on scale and sunset, somewhere between, usually we average out about 2%. So for very small deals, maybe 2.5, as long as I'm getting the debt. For the larger deals, I've done as small as 1.5, but it was like a $75 million raise for a client that was repeat client. Now, who pays for it? It's an interesting question. Our argument has always been it becomes part of a capitalized deal cost. So in theory, if somebody's putting up 90% in equity, they're paying 90% of our fee, which is why I've stopped asking for 3 points, because the LP are saying, forget about it. There's no way we're going to pay 3% in the deal for you. It's 2%. And so now we're forced to go back and make a decision. Do we want to lean on the general partner to pay our fee, which we're owed? And then we have to make a decision. Do we want him as a future client or not? If the answer is no, too bad, you got to pay out of pocket outside the deal. Otherwise, again, you know, we get the dev and But yes, equity fees are a capitalized budget item that the lender recognizes and the LP recognizes to a certain level. Okay, keep going. All right. I went through the fees, right? Asset management fees, it's bupkis, we don't need that. Co-invest I covered, right? Now, waterfalls. So there are 2 ways to think about waterfalls and splits. There's what I call the country club model, which is you put in 90, I put in 10, and then we split 30-70. Easy, right? I can do that math in my head. Institutionally, we don't do that. We do promotes. So I'm actually going to draw it for you, and then if you want to, I can show you how the math, actually, let me just show you how it works. If anybody's interested, I'm happy to send you a model or something. But here,
Country club is not IRR driven. It's just you get your money back.
There are 50 different ways to do country club. There could be a return of and on. There could be a return of and then a split. There can be a split of the operating cash flows and then a capital event. In the institutional world, there used to be 2 splits. One for operating cash flow, so I can actually get promoted if I maximize the cash flow, and then another split when we have a capital event, like a refinance or sale. Today, it's all combined for the most part, 99 out of 100 times. So in other words, it is when you do value add and opportunistic deals, there are two metrics that are usually measured, IRR and equity multiple. When you do core plus, it's all IRR based. And I'll talk, anybody hear of the equity multiple concept? Right? So just touch on it. IRR is simple to understand, right? It's time value and return based. But if I do something really quickly, right, I might get a 50% IRR, but the total dollars I made was probably 20 bucks. Not great, right? So I can actually buy out my partners because the IRR is really high, but the cash amount is very low. And for those investors that have closed-end funds, once the money comes out, if it comes back in, they can't redeploy it. So if they earn a really high return, but like $10 in total profit, that's a loss for them. So they have in their documents, we must earn the greater of 17% IRR or a 1.8 equity multiple. Therefore, you can't hold on to the deal too long. Because if you give me the deal for 20 years, I'll give you 2x on your money, no problem. But you can't make the IRRs, right? So it's meant to keep you to a time frame, but not too long and not too short, right? On the core plus deals, which tend to be time, I'm going to hold for 10 years, multiple is irrelevant, so it's much more IRR prone. So, promote, bonus. Here's how I always, sorry, I keep seeing my back the whole time. Here's how I envision it. I'm going to go through a couple of slides. Did I mention I'm a bad drawer? Okay. Okay. Let's make this a faucet, and money is flowing out of it. And there's two buckets to capture the money. Okay. One is the money bucket, which is owned, in this deal, 90-10. 90-10 by the LP, 10% by the GP. Make sense? The other bucket is the promote. Okay? So this bucket holds the cash. This bucket holds the promote. And just money is falling. It's a great, great time to be alive. Right? Okay. Ignoring return on and off. When I teach this, I always think about IRR. Because there's actually very little mathematical difference if you do a return of pref and then a return of money. IRR by definition means I got my money back and profit, right? So in this tranche, and I did a multi-tier tranche, meaning there's multiple levels. Before a 12% return is earned by all the money. All the money is going to drop here. There's no promote. And for every dollar that comes out, it's going to get split 90-10. Right? Make sense? There's no promote, so all the money has to go here. So for every dollar that comes in, it's going to get split 90-10. So what does that mean? $90, and GP is going to capture 10%. Okay. Once I hit a 12%, that means, hey, I've returned a baseline to you. Okay? I've done good. I now get bonus. And after a 12% return, but before a 17% return, when I use the word return, I'm using IRR in this case. So after a 12% return, but before a 17% return, I will get a 30% promote. So what does that mean? For every dollar that pops out of here, 70 cents is going to go into this bucket. 30 cents is going to go into this bucket. How is the 70 cents split up? How much did the GP get? 10%, 7 cents. How much does the LP get? 63 cents. Who gets the promote?
The GP.
The GP. So in this tranche, we think of it as tranches, the GP gets, of every dollar that comes out, 37 cents, and the LP gets 63 cents. Make sense? Just in that tranche. Okay? Promotes are progressive. What does that mean? The better you do, the more you get. Right? So then we get into the, I Damn it, it's so much easier to erase. All right, I'll do it. Next one is what? So let's see. The LP gets 1 take away the 30% times their investment of 90%. There's your 63%, and the GP will get the remainder, 1 take away that. Okay. I just want to show you how the splits work. Okay. Then we go into the second tier, 40% promote. So after a 17% IRR, but before a 20, I now start getting more. I get how much? 40% promote. So what happens? For every dollar that comes out, 60 cents goes to this bucket, 40 cents goes to this bucket. How much did GP get of that? 06. How much goes to the LP? 60. Thank you. Dude, if this room isn't bad in math, I don't know. Please. General partner gets all of it here, 40. So what happens in that next tranche? GP gets how much? 46% of the deal, and the LP gets 54% of the deal, right? The comparable answer is, oh, we put 90-10, and then we're going to split it 37-63. But nobody says that. They always say 30-20, 80-20, whatever it is, right? That's why the country club split is very different. It's very hard to compare. I like comparing this because I can compare 20% promote to 30% promote. And I can also calculate the cuspiness of the different tranches.
Like in one deal? There's levels in one deal?
Of course. I don't want to say of course. The answer is yes, there could be. It could be as simple as, I wish there was a 50-50 over an 8. I wish. In the private market there is, maybe. In the institutional market you would generally get at least 2. At least you should be able to get 2. I have seen something called the super promote where you get a third sort of, if you really blow the doors out, you get something extra. In the last tranche, actually let's finish this math, right? So equals 1 take away the promote times my 90%. And if anybody wants the spreadsheet with all the answers on top of it, I'll be happy to email it to you. Equals 1 take away that. Okay? So now I'm in the last portion. After all the money has gone at 20%, I'm in my super promote. 50-50 finally. Right? What happens? 50 cents goes here, 50 cents goes here. The GP captures now 5 cents. The LP captures 45 cents, right? They capture 50 cents here. So in this tranche, what happens? 50 plus 5 is 55% of the deal to the GP. And the LP gets 45. So what, winds up happening? The better the deal does, it's like progressive taxing. That's exactly what that is, right? Everybody here pays taxes, right? Unfortunately, especially in New York. Right? So the government takes a bigger chunk of every progressive dollar, and that is what promote is. A promote is actually on a tax to the limited partner. And here's another concept that you should understand. Okay? You see this IRR here, the 28.4? If the preferred return is lower than the IRR, or said another way, if the IRR is higher than the preferred return, the limited partner will never make that. I'll repeat that again. Okay. If the IRR in a deal is higher than the preferred return, the limited partner will never get that IRR. Why? Because I'm taxing you. If the deal only hit a 12, what would our splits be? 90-10. You would only make 12%. But because now the deal is doing better, the sponsor, the GP, gets an outsized portion to their investment. Where does that money come from? It's not out of thin air. It comes out of the LP's portion. So the better the deal gets, the more of it gets. So a promote is dilutive to the LP. Yes?
So when you present the deal and you show the IRR, you're really presenting your numbers. I mean, it's nothing. You have to use, I guess, as an investor, you have to know how to break that down.
Oh, yeah.
See how it's going to get.
Yeah.
So not even your number, right? Because your number's higher than that.
I'll send you a waterfall.
So well, I'll
show you what your real IRR is as I
so the answer is, like for example, when we go out to raise capital for sponsors, I've gone away from providing waterfall models for two reasons. It's not that they're stupid and won't be able to do the math. Everybody can, they all have their own models. They can easily figure out what I'm making as a GP, right? It's 50%, 70, whatever it is, like they get it. The reason why I don't do it is because every firm has their own waterfall model, meaning the different structures. Some are sequential, some have different prefs, some have different, so like, they'll tell me what their structure is, I'll model it, and then we'll figure out how to negotiate it. So we actually don't do that at the beginning. It doesn't make any sense to do. For those of you, for example, that do private, if you do like a PPM and you're like, hey, I'm going to charge you a 20 over an 8, of course you're not going to show that guy what your return is. You're just going to show them what their return is. So the rule of thumb, approximate, on a value-added deal is there's approximately 2 to 250 basis points, meaning 2 to 2.5% of scrape on the IRR to the limited partner. So what does that mean? I bet you if I do all the math here, give or take, and because the IRR is higher than the 12%, the limited partner will probably get somewhere around 26% return. That's my guesstimate, 25 to 26, and the general partner will probably make a 40 or 50. I bet you if I run this model, that's what would happen.
I have a model there with very similar numbers that shows GP and LP, so you can, if you want to check it, you can do that.
I got it. Actually, here. I didn't finish modeling this, I think, right? I didn't finish modeling it through. Let me just keep going before I forget. So promote is dilutive to the LP, okay? And the rule of thumb that we use with institutional investors is, in a typical 90-10 deal, regardless of your pref or your super promote, because those are just accordions, right? If the LP is concerned about security, meaning they want safety, they get a higher pref. As a sponsor, I want to get as low a pref as possible and as large as a promote. So it's an accordion, right? You give and take on both sides. On a 90-10 deal, as a general partner for institutional world, you will capture approximately 30-ish% of the economics. That is the rule of thumb. Means, I will capture 30% of the deal, or 33% of the deal, something like that, 30-ish, in the low 30s. And all the stuff in between is just noise. Now, I'm very good at math. I can negotiate different tranches. I can see, based on, calculation, how much goes into each one. So I know, I'll give you 1% here, but I'll take 0.5% in here, and that 0.5% is actually worth more in that tranche. So I can do the math. But it always winds up to about 30-ish% of the economics, okay? That leads me to the last financial structure. So everybody good with this? Understand? Just basic concept, right? Buckets. Always think of buckets. It's always simple that way. The last structure is the sequential structure. And I will tell you a deal that we just closed. Multifamily in Tampa. The GP put in 15%. The LP put in 85%, and it was like I don't know if we're connected to the internet. It's up on the website. I remember it's like $35, $40 million deal, something like that. So it was institutional quality. It was a senior subordinate structure. Sometimes people call this preferred equity. I disagree, because again, if you remember, preferred equity is where? Here. This was going up to last dollar. Right? They were giving me 85%. So where were they? They were actually somewhere like over here. So they were going up into 96% of the stack. That's not preferred equity. That's equity, I promise you, even if you call it preferred equity. So we think of it as senior subordinate equity structure or sequential pay senior structure. Doesn't matter what you call it. So 1585. And here's the waterfall. First, by the way, acquisition fee was paid. First, the LP gets a 14% IRR. I'm going to write this out, then we can talk about it. Next, the GP gets a 14% IRR. Third, you split the deal 85-15 in favor of the GP. What does that mean? In this particular deal, unlike the pari passu structure where you get 30% of the economics, the sponsor captured about 75% of the economics. 85-15. So the LP got a 14% IRR. That means a return of and on. So the sponsor was subordinate to that 14 pref. Then the general partner caught up with the 14%, and then everything that was left over was split 85-15 in favor of the GP. How much money did the GP put up? 15. That is a monstrous promote. Monstrous. Why would somebody do that? Well, let's think about it. If you are doing value add, here's true value add. Market is here. Deal is here. I'm going to move the deal to market. That is really what value add is. It is not the market's going to move. It is all I'm going to do is move to market. Okay? If you do everything right, meaning you execute your business plan on a traditional pari passu deal, you capture it's like a double, maybe triple, right? If cap rates don't move and such. Okay, because I got 30% of the profits. Here, if all I do is execute my business strategy, right, and these deals were shaking out an 18-19% IRR return, on a pro forma, everything always shakes out to an 18-19% IRR, they got an 85% of the upside after 14. That is huge. Why would they do that? Well, the sponsor shockingly believed in the business plan. Simple as that. They believed in the business plan. They said, man, they just simply counted. I would make $2 million under this structure, or I will make $4 million under this structure. Which do I want? All else being equal, I'll take the 4. And they felt that because they were just trying to move to market, even if the market went down, they would be able to maintain a coverage of 14 and they could work their way through it. Why did the equity do it? The equity was saying, we're worried about the market with basis. In fact, in this particular case, the equity just sold a property down the street at a lower basis than this property, even though I think they were not comparable, in my opinion. I thought it was a different cost structure. They were saying, look, we exited at $70,000 a door. You want us to buy in at $78,000 a door? We don't want to. But if you subordinate your equity to us, we're entering the deal at the basis that we exited. We feel okay. And in fact, we can sell it to our investment committee because if we do it otherwise, we're the schmucks that sold too cheap. So there's a lot going on back there. And so they took the lower basis. In return for that, they gave more upside. And so to their fund investors saying, listen, yes, we're not going to make a 17 like we normally do. We're going to make a 14 plus a kicker, so maybe a 15 or 15 and a half. But look, we're in a much better basis. And we're seeing more and more of this where the equity will trade off a couple of 100, 150 basis points of return for that stability of being lower in a cap stack. And the sponsor on a value add deal, I'm all for it. Here's where I'm not for it, and this is where I get on my soapbox, if I had one. In my prior two companies ago, I did a lot of business in Miami and Vegas, raised debt and equity. And my company, and I invested probably most of my fees back into the GP side with one particular sponsor. On paper, I was worth a lot of money, or so my ex-wife thought. And we wound up doing a senior subordinate structure. So we were, in that position. Everybody remember what happened in 2000? Well, in Miami it was even faster. In 2006, what happened? Right? What happened with us? 100% wipeout. And so I would never do this on a development deal because the development model is very simple. I built to 100% of replacement cost, meaning at cost, and I got to sell for 120 to the next guy. Great when things are great, not so great when things are not great, and so I don't want to be in the last dollar position. On the value-added deal, I feel much more comfortable. So here, I actually invested with the guy. I thought it's going to be a grand slam like this. Development deal, never.
Even this deal, depending on the market, you might not reach that. You might reach only 70, 80% of that.
Maybe. But again, we were comfortable. We could be wrong, but we were comfortable.
Are you taking full responsibility as well, as far as recourse, the GP?
It was a non-recourse loan.
About the bad boy or whatever.
Yes. Yeah. Bad boy carve-outs all on is in a GP. Correct.
So that's also protecting.
He got an acquisition fee and an asset management fee, and we have to fight tooth and nail for the asset management fee, and it's actually subordinate to their. It's like one of those asshole LPs I really despise. They actually crammed us down in our second deal. They didn't want us to get paid 2 points. They said it's a second deal with the borrower. You should only get paid 1 point. We're like, no, our agreement says 2 points. They go, okay, fine, but get it from him. We went to get it from him, and they said, fine, but you have to invest. You have to pay them outside of the deal. We don't want you to pay it into the deal. And we were like, why? They said because that we get a 85-15 after you get a return on your money. If you pay them it allowed it to about $8,000. So they were fighting with us over $8,000. So they're on my, they're on my crap list for $8,000. They were fighting with me. That's if everything went right and the cash flow, if the sponsor paid us through the deal, that's how much less they would have made on a $40 million deal, and they fought with us. So they're in the penalty box, huh?
Why'd you just do a deal with them?
Because of the schmucks that gave us money. Go. That's it. I'm good. I don't want to do any more math. My wife's going to kill me. Any questions?
How does the opportunity zone in general affect the ability to raise or maybe perhaps how to change your approach?
That is a very broad question, right? So the source of money simply is aggregated capital, right? It doesn't change the source of the money, it's just now the motivation of the money. And there's inherent problems with it, such as 10-year hold, such as the people that are already in opportunity zones have marked up their land and property in anticipation of that. So when I see a deal in Detroit that pencils to a 6 and they tell me, don't worry about it, you don't have to pay taxes, I'm like, it's still a 6. I'm pretty sure I could do better somewhere else. I was not around in the 80s, but I heard a lot of great stories of what happened when the tax law changed and when you were motivationally investing just for taxes and when things went sideways. So to me, I'm not the right guy to ask. I generally think that the economics are the economics, and that's how you should be motivated.
And sure, you're saying that
Plus, in 10 years, when everyone's going to want liquidity in the same freaking market, good luck selling. Knock yourself out. Now, we will buy a ground